Most traders open a 15-minute chart and wonder why they keep getting stopped out. The reason is that they have no idea what the higher time frame are telling them. In this video, I'm going to be starting from a completely blank chart on BTC with no indicators and no bias. And I'm going to be showing you exactly how I build my directional bias on Bitcoin from the monthly time frame all the way down to the 1 hour time frame. By the end of the video, you should be able to understand the charts exactly how I do and never look at the charts the same way you used to. Now, starting off with the monthly time frame, keep an eye on the key down here for your information. Let's start off with the monthly time frame and mark on all the key areas where there is liquidity. Now, let's start off with marking this as a liquidity sweep. So we can mark this on with a dotted line. We can see here, price has moved up, swept liquidity, come back down, swept liquidity again. That's a liquidity sweep. We also have another liquidity sweep right here. And then we have liquidity sweep down here, but this is also a break of market structure because as we come down, we've closed below this swing low down here. This is known as a break of market structure. Now let's mark on all of our buy side and sell side liquidity. So we have sell side liquidity resting below down here, and we also have buy side liquidity resting above down here. Essentially, buy side and sell side liquidity is where we're expecting the retail traders to have their stop losses, whether they are in swing trades or even just scalp trades. They're likely to have stop losses at these liquidity areas down here. We also know that we have sell side liquidity resting down here. Now let's mark on any other key things. What we can see, if we zoom in just slightly a bit more, we can see price has come up recently into a fair value gap marked on just down here. So we can mark this on with a fair value gap, and price has tapped into it and rejected it. So that's a fair value gap there. Now we can see down here that price obviously is overall trending upwards. We've got a retracement as we come up in key areas, but we know overall price is trending to the upside. Now that we marked on all of these key areas, what we can see is as price moves up, we're getting retracements. As price moves up, we're getting retracements. If we're getting another move up, are we going to get another retracement? That's the question we need to ask ourselves. And the only way we can answer that is by understanding more on the lower time frames. But let's put on some key things. Now, these are the things that most retail traders are missing. What we need to understand is where is price right now? Now, if we can mark on a fib from these lows to these highs down here, what we can see is price has come into a key area, 65,500, the 79% fib level. Now, what does that mean? Price came into it once, twice, 3 times, and we rejected it and closed above it. This is a good sign because this is telling us price is attempting to close below these levels at 65,500, and we're failing to do so, and we pushed away from it. Now, the fact that we pushed away from it, where have we come into? We've come into this fair value gap and price has grabbed liquidity. Now that we've grabbed liquidity at a key area, what can we ask ourselves next? Where do we think price is going to go? Well, essentially, what we need to understand is the way that price moves. Price moves based on liquidity. We grab liquidity here, we move up. We grab liquidity here, what are we expecting? The possibility of us moving back down and coming to grab the liquidity that's resting here and also the liquidity that's resting down here. Now, if we take this a bit more deeper, where has price actually come into when we tapped into this fair value gap? So if we mark on our dealing range, we've got a high down here and a low down here. This is basically where your dealing range is. And essentially what we want to look for is the midpoint of the dealing range. We can see this 50% dealing range level at basically 79,000. Now, what we want to understand is anything above this area down here of 0.5, basically anything above 79,000 is known as your premium side of the dealing range. Therefore, price needs to tap into this area for us to look for shorts. And these areas down here, anything below 79,000, as price comes into this area, we want to be looking for longs. So essentially, what we can see is price has come into the premium side. So therefore, we should be expecting or anticipating for the move to the downside. But let's continue on the lower time frame to see what else we can identify. Zooming right in just into this price action down here. what we can identify is bullish price action on the way up to this fair value gap. We can see price has been moving up, retracing, and we've moved up and we've swept the liquidity down here at this fair value gap. Now, we can also put on a fib from these highs to these lows. We haven't yet tapped into the 62% level. So therefore, this is a sign for us that there is a possibility we may come sweep up first. Sweep and take this liquidity and then come rolling down. Prices come into the discount at the moment, but there's a possibility we can come back up, coming into the 62% level. Now, on the weekly time frame, what else we can see is the liquidity that's resting above down these areas here and these areas here. Now, price did come down over the last 2 weeks. We swept the liquidity below all of these areas, and this specific area down here, we swept it and we closed above. Now, price has been trying to move to the downside. As we get this push up, the candlesticks are telling us a story. So zooming right into the candlesticks, we can see that we had this bullish candle when we broke into the 79,000 level, but then we had a full retracement to the downside, engulfing the previous candle. That was our first sign that there's a possibility that price will continue moving to the downside and grab some liquidity on the lower time frame, which I'll show you in a second. And exactly that is what happened. We grabbed the liquidity down here. We swept these levels down here as well. And price is likely going to move up from here, in fact. So that's what we're looking at. Now, just to summarize, back on the monthly time frame, overall, we can see price has been trending upwards. We've been having retracements on the way down, but price has been trending upwards, okay? We've come into a key area down here. So therefore, we know that there's a possibility that we can bounce from here. We had the bounce from here and price tapped into a key area. Now we need to know, where is price going to reverse from this area? Going on the weekly time frame, we have come into the fair value gap, but we haven't swept the liquidity at the 62% level, or we haven't come deeper into this premium side of the dealing range. So therefore, there's a possibility short term we will move to the upside. Now let's go on the daily time frame to see what we can identify. Let's zoom right into the price action that we're having right now. We can see price is moving to the upside. We're sweeping liquidity, but we are moving to the upside. Every time we get a retracement back, we move to the upside. Retracement back, move to the upside. This down here is known as your failure swing. We had a failure point down here. Price comes up, down, comes back up, fails to take out this high down here, and moves deeper to the discount side of this dealing range. Now, where were we expecting price to get into? Now, as we get the move down, this was our sign. This first failure swing was our sign that price is likely going to come to the downside. Now we need to ask our question, where is price going to bounce from? Now, this is where we need to put on any other key areas down here. So we can see a fair value gap right here that price did initially tap into 1, 2, 3 times, move up, and then we close right into it, below it. But where would we then expect price to move into? We've got this liquidity down here. And these are the areas that we need to look for. We have liquidity down here. We have a sweep of liquidity. So this is essentially where we should be looking for price to come into and sweep. We also have an order block resting just down here. So we can mark that on with our high time frame order block as well. So therefore, what we're expecting is the move down. We know that there's a possibility of price coming to the upside. We had a failure swing down here. Now, when we had that failure swing, this is our opportunity to take shorts to the downside, targeting fair value gap number 1, and then this sell side liquidity. As we move to the downside and tap into these key areas, into the sell side liquidity, into this order block, we should then be looking for short-term long opportunities, either up into this buy side liquidity area here, or price actually coming to take out these highs down here. Now let's go on the 4-hour to see what else we can identify. What can we see? We can see a market maker sell model. And what that basically means is we have consolidation or initial swing point down here. Price moves to the upside, a failure point down here. And what we want to see then, if we call this the buy side of the curve, this is your sell side of the curve down here. That's why I put a line in the middle. Now we had the failure swing down here, and what we can see is bearish order flow. And essentially, what we would like to identify is when we get the failure point down here, where do we expect price to go? We look for the swing point down here, and this is the best opportunity for you to take shorts to the downside. So we can see possibilities, endless possibilities to take shorts to the downside as we move down and target these areas here. Now, as we target this area down here, of course, we're going to expect a bigger push to the upside. Now, essentially, although we're still bearish on the 4-hour, what I'd like to see to confirm that we're likely going to continue moving up is a break of market structure down here. Because what we would have is a move to the upside, possibility to retrace back into a key area like this order block, or even deeper into this fair value gap, and then the possibility to move to the upside. So another entry down here if we do get the move to the downside. So there we have it. That's the full top-down analysis. Monthly gave me the narrative, weekly confirmed the direction, daily showed me the draw, and then the 4-hour built the setup. That's what we want to identify. And this is the exact process I run every single week. And if you want the full weekly bias breakdown every Monday, hit that subscribe button. I post it every week.